Uh, I am happy to announce that we have a very good panel of five very experienced people with the internet. And because of the delays that we've had in starting, I think I will go ahead and start with the first presentation by Luis, Inflation Trends and Devaluation in Cuba.
All right. Thank you, Joaquin, and thank you to ASCE for having this conference. Let me share my screen now. Get rid of this here. All right. So my talk today will be about inflation, and I will be looking at recent inflation in Cuba, and then at the impact of the devaluation on prices, trying to gauge what the short-term, very short-term impact might be, so that we will look at the inflation trends and then the transmission mechanism from world prices, relative price distortions, the impact of the devaluation, the question of price controls, and what about stabilization policy. Now, these are recent numbers. The government publishes only the consumption deflator, ONA publishes the consumption deflator. The 2020 number just came out essentially as we speak, a couple of days ago. And so we have it was 3.2%. CEPAL produces a consumer price index, presumably on the basis of a basket of prices, and it's essentially negative in average for the last 5 years, and whereas the ONA consumption deflator is a little bit over 2% on average. But today, just looking at the numbers just published for 2020, all kinds of astonishing numbers come up about recorded inflation for last year, which sets the stage for what is happening. And one astonishing number is that the price inflator for education for 2020 was a 103.1% increase. So this was a massive increase in salaries of teachers and so forth. The other one is the health deflator, was up 48% for 2020. And the GDP deflator was up 17% for 2020. So this means that Cuba is starting, just previously to the devaluation and the Ordenamiento, with a period of significant inflation, as opposed to the trend in more recent years to 2019. Now, in order to look at the relation of consumer prices to international prices, I use essentially an accounting process whereby consumer prices are essentially equal to exchange rate E times international prices at a weight of alpha, which is essentially non-tradable. I mean, tradables is the share of tradables in the economy. And here we have non-tradable prices, PN. So that, as we know, PT equals EPI. In other words, tradable prices, which are all items and services that are potentially traded internationally, is equal to the exchange rate E. In the case of Cuba, we will deal with this later. This E is essentially an average of inflation because we had two currencies. It's an average of two currencies, the CUP and the CUC, up to the end of last year. So the interesting thing is that when we calculate alpha for the last decade, the number in Cuba comes up to about 0.198, in other words, almost 1/5. So the share of tradables in the economy is about 20%. This is extremely low. Samples from other countries are much higher. For instance, in a study by Ravelo and others, the alpha for a number of developing countries is between like 43% and 65%. Argentina, which has the lowest alpha in that study, is 43%, 0.43. So Cuba has a remarkably low share of tradable goods in the economy. And the main explanation for this is that essentially Cuba has had, for most transactions, for most government transactions, a fixed exchange rate of 1 to the dollar, so that this has repressed essentially the prices of tradable goods. So here we look at the data we have. As I said, in Cuba we have essentially deflators, and what we have here, we use imports, the blue line, as a proxy for tradable prices. Most exports in Cuba are not really tradables. They are, the most important ones are services like medical services and tourism. So this is a proxy for tradables, and households deflator is the green line, and government deflator is the red line. So essentially the way this works is that since the weight of tradables is 20%, we see that the government deflators and the household deflator are pretty close to each other during the period. Now, I have not incorporated these recent numbers that came out in the last couple of days, and that will provide a little bit of a shift. Now, the relative price of imports has dropped since 2010 to 2019 by a figure of about 50%. So this means that the fixed exchange rate has had a huge impact on the relative price of tradables during this period. Now, as a footnote, this is also a problem for foreign exchange liabilities. Even though it's not the same curve, we've had essentially a massive distortion in the domestic price of Cuba's foreign exchange liabilities, which are going to be, of course, being hit by the devaluation. Now we're looking at wages. So we see up to 2019, we had an 8% average annual increase in state wages, and the household deflator and consumer deflators behave fairly similarly. But 2020, as I said, is going to be a radical change here in state wages. And I haven't looked at they haven't published the wage data for 2020, the exact wage data, but this number will be much larger than 13%. So that what this means essentially is that there was a substantial amount of pent-up demand in the economy caused by a significant increase in wages in 2020. And here we see the relationship between state salaries and real household consumption. And we're beginning to see it here, where state salaries are moving ahead of consumption, and 2020 will be much more pronounced. I will have to update this slide. Now we want to actually, in order to understand consumer inflation, we want to get to retail prices of tradable goods. And I use an extension of equation number one. The retail price of tradable goods is equal to the exchange rates of the two currencies that we had up to 2020, the CUP or peso and the CUC or convertible peso. And this K is essentially the internal exchange rate between the two currencies. Beta is the share of CUPs or pesos in the economy. Now, calculating this beta is a bit complicated because we don't have precise data on transactions, and the figure ranges, as I use it later, between 7% and 15%. Although the share of the convertible peso in the money supply, which I was able to get from monetary data in 2017 was 39%, but that's not equivalent to the foreign exchange market share. Now, non-tradables, we use And these are accounting equations, essentially. They're not really market equations. We are just trying to mechanically look at the relationships, at least in the very short term. So non-tradables are a function of labor unit cost, W, and an elasticity of unit labor cost, gamma, and also a variable for the input of tradable goods in the production of non-tradables. And theta is the retail margin variable. Now, using all of this, I'm trying to gauge what the impact of the devaluation is, and using equations 1 to 3, and different assumptions about such things as the share of tradable goods in the economy, and the share of CUPS in foreign exchange transactions, and the unit labor cost elasticity of non-tradable prices, and the proportion of tradable goods in non-tradable production. So using different assumptions, and I calculate this from available national income accounts, we get a range of estimates for the initial impact, which I gauge to be, let's say, 1 quarter. I don't really know. There are time lags, and of course, there are price controls in Cuba. So these estimates apply in the case that there were no price controls, what inflation will be in terms of consumer prices. And these are multiples. And here we have, this is the consumer price deflator, as it were. And the multiple ranges between 5.7 times to 3.8 times. In other words, between 470% and 270%. My gauge is that the assumptions that I believe are more realistic are case 3, and I'm not going to get into the detail of it. So that will give us inflation of about 350% for a 1 quarter impact. And again, there are lags, so this is just a guess to some point as to what the time lag is. But this will be a gauge of initial inflation. Now, when we look at actual prices, then we come up with a problem. What the actual consumer price index, if Cuba were to have one, which they don't publish, and we have to gauge the one from CEPAL's consumer price index, we'll have to look at actual prices. Now, let's look only at the 1 month price change. Now, the first set of numbers here are from Pedro Monreal, who looked at Acopio is the government wholesaler that buys directly from farmers. And these are the retail prices, the top retail prices in the first month. Now, they've changed a little bit since then. So we have a whole range. Pumpkins were up 420%, guava, so forth. The average is 125%. And the control retail price, however, actually declined a tiny bit. Now, the crazy thing, of course, is that gasoline prices, they have been changed. But in the first month, they were up 2,200%. So how do you explain a farmer is going to buy diesel fuel or gasoline for his equipment and make some money when the Acopio prices are controlled? Now, since then, the gasoline price is now up 1,300%. They declined. They adjusted some of these control prices. One of them is the fuel prices, which now has been lowered to an increase of 1,300%. Now, the same with electricity, and these are the actual prices today, so that for low consumption, for 100 kilowatt hour, the increase was 128%. And this is a very tiny amount of electricity. As Omar Everleni said this morning, well, a light bulb can be 100 kilowatts. So if you have it on, you have 4 light bulbs on a month, you use 400 kilowatt per hour. Now, if you consume 5,000 kilowatts, then the increase in prices was 100%. The other interesting element is the parallel dollar. The black market dollar was up about 1/3 between December and mid-July. Now it's up a bit more. And by the way, the bid-offer spread, as I look in I know Rafael and Gabriel are going to talk about this, but I look at the bid offer spread that I find when I look at the internet quotes are around 20% for the parallel dollar. That's another cost involved in the system, and of course has to do with the degree of illiquidity in the system. So essentially, we get a sense of what the actual movement in prices are, but because of control prices, then whenever we get an index of consumer prices, when we get it, it's going to be well below the estimates that we have here. Now, obviously, the inflationary dynamics are daunting. The estimates of the fiscal deficit, they range all the way from 20 to 30% of GDP for 2021. As I said, the dollar black market is up about 100% in 7 months. So this implies continuing inflationary dynamics. There are major supply bottlenecks in food production and in the production of medicines, all kinds of household goods. And very importantly, the dollar crunch will continue. The expected recovery in current account receipts is now being delayed. There was some expectation that tourism may revive, that there may be some softening of sanctions regarding remittances, for instance, and there's been no change in that. So essentially, there is a dollar crunch that will continue. According to the latest numbers from the BIS, which is a proxy for reserves, the loss of reserves in the first quarter would have been about $200 million in the first quarter of 2021. So that we have about a loss of about $200 million per quarter for a total of around 1.5 billion in assets in international banks, which are a proxy for reserves. So that's a pretty high burn rate, as one would say, for reserves, and therefore one would expect continuing shortages of imported goods. Now they have an inflation problem, so we'll do one here, and the stabilization questions will be, as I said, quite daunting in Cuba. So the conclusion is that there was low inflation in the last decade, assisted by currency revaluation, and peso devaluation in the absence of price controls would lead to initial quarterly CPI of 300 to 350%, while the devaluation corrected relative prices, expensive fiscal policy, product, and dollar shortages, as well as parallel peso weakness, signal continuing inflationary pressures. Thank you very much. We cannot hear you. Joaquin, we don't hear you.
Yeah, we will pass to the next speaker, Ernesto Hernández-Catá. So if you want to go ahead, yeah, please.
Okay, thank you. My topic is the role of expectations in Cuba's foreign exchange system. Let me just put in my PowerPoint. I don't see it.
It sometimes helps to bring up the PowerPoint before you do the screen share. Oh, where'd Ernesto go?
Can you hear me?
Ernesto.
Yeah, can you hear me?
We can hear you, we can't see you, and we don't see your PowerPoint.
Well, because I can't get it on.
Did you bring up the PowerPoint before you did the screen share?
Yes, I did. I share, and I share again, but it doesn't come up. So let me see what's happening here.
Hmm.
I think
Ernesto, unmute.
just hit from the beginning.
Hello?
Ernesto, you're
Ernesto,
unmuted again.
can you unmute?
I click on it, okay.
And click on from the beginning.
Mm-hmm. Okay,
There.
we're there?
Yep.
Okay, Cuba's foreign exchange system that has existed up to this year for about 3 decades. This is a monument to the communist adoration for unnecessarily complicated schemes. The system has introduced considerable distortions in the Cuban productive system, and I think it's done considerable damage to the Cuban economy. So it's a bad system, but it has to be understood nevertheless. Here's a basic structure of the monster. 2 currencies, the non-convertible coup and the convertible, allegedly convertible kook. The coup itself has 2 exchange rates, the official exchange rate of the peso, which is 1 to the dollar, and has remained like that for ages. This applies to most of the Cuban economy, most transactions in the Cuban economy. Then there is the much smaller parallel rate or Cadeca rate or exchange bureau rate that applies mostly to households with some important exceptions, tourist expenditure and remittances. So this is the basic structure of the monster. Let's see how it has evolved over time. You see on top the blue line is the floating parallel rate, which during the so-called special period shows enormous volatility. It depreciates sharply at the beginning of the period, and then it appreciates almost as sharply later on when stabilization program is involved. It then wiggles around a little bit, but beginning in 2002, this rate is basically unchanged until 2020. Then the other one, the most important one, is the official coup rate, and that you have to go well below the chart to this red broken line, and that has been constant since the beginning of the special period through until it was finally devalued early this year. So the question is, since the rate is fixed, what happens to expectations in that context? Expectations are a basic element in models of exchange rate determination. But what do you do when the rate is fixed? Well, that doesn't mean that expectations have to be of zero change, because people may have their ideas about whether the authorities are going to be able and willing to maintain the fixed rate, and so they have expectations about a possible devaluation. Unfortunately, existing models don't help us much in this context because they basically apply to floating rates. What I propose here is a model that has two elements. The first is a subjective probability of a devaluation in the next period, lambda. The second is the level of the expected exchange rate that is expected to prevail after the devaluation. That's the letter phi. And equation 3 exemplifies that. The E with the little snake is the expected exchange rate. So the left-hand side is the expected change in the exchange rate. That's a function of the probability, lambda, and of the gap between the expected level of the exchange rate minus the current exchange rate, which is 1. So what are the elements of lambda? Let's look at the extreme cases. If lambda is equal to 0, then the right-hand side is 0 and there is no change. No change is expected in the exchange rate. If lambda is equal to 1, then the rate is expected to depreciate all the way to its equilibrium level phi. Next, we assume that the subjective probability of a devaluation is a function of the level of official reserves. Okay, and I take official reserves, Luis has talked about that, from the data of the BIS. A max is the maximum value of reserves during the period. And the whole right-hand side is done so that I can convert the level of reserves, which is given in billions of dollars, into a probability, so it is consistent with lambda. Now, I combined the equations we have seen so far, and I get to equation 5, and in equation 5, the level of the expected exchange rate happens to be a weighted average of the expected level of the exchange rate post-devaluation and the existing exchange rate, and the weights are functions of the level of reserves, modified by equation 4. Notice that all the variables here in equation 5 can now be quantified. Again, alpha bar comes from the BIS claims on Cuban claims on reporting countries. Phi is 24 because I assume that the equilibrium exchange rate is equal to the Cadeca rate, which throughout the period was considered as something that might approximate an equilibrium rate. And of course, epsilon is equal to 1, that's the fixed exchange rate. So I can quantify everything here, and I can plot that. In this figure, you have the red line, the fixed coup rate, official rate below, the blue line, exchange bureau rate above, at 24 per dollar, and the broken line is the expected official rate, which, as you can see, declines first, bottoms out in 2010, right after the financial crisis of 2008, 2009, then it zooms up again, and at the end of the period, it approaches an expected devaluation of almost 20%. Then I ran another exercise in which the variable that drives expectations, the probability of a devaluation, is not the level of reserves, but it's Cuba's fiscal deficit. Now, that might not be a good proxy for what drives the intentions of the authorities, but it's a fairly good proxy, I think, for what scares the people up. When they see the exchange rate rising, because the exchange rate absorbs, the movement in the exchange rate absorbs public saving and therefore has a negative impact on the exchange rate. when people see the exchange rate, the fiscal moving, they increase their expectation of a devaluation. That's quite visible here because initially the expected devaluation is relatively small. I say relative because devaluation from 0 to 10 is not to be neglected, but it's relatively small compared to what happened after 2014, when the expected exchange rate zooms and approaches full devaluation to the equilibrium exchange rate in the recent period. So that's the tool we have now. The model cannot be tested. It cannot be tested for the excellent reason that the expected exchange rate cannot be found. But it does tell us something about how people might form their expectations, even in a system in which the exchange rate has been declared fixed by the authorities. Let me conclude with a remark on the future. Now that the peso finally has been devalued, the authorities face the dilemma of whether to keep the exchange rate fixed at 24 pesos per US dollar, where it is now, or to allow the peso to float. Fixing the exchange rate and continuing an expansionary fiscal policy as it has been in recent years would repeat the unsustainable sequence of overvaluation and crowding out of investment that we've seen during the life of this system. The lesson, I think, is clear. A return to the discipline of fiscal policy of the mid and late 1990s and a floating exchange rate, perhaps with some intervention by the central bank to smooth out volatility. That's what is needed now. The repetition of a fixed exchange rate that we had and produced all these problems of overvaluation and crowding out of investment, that is a recipe for disaster that the authorities will one day regret. Thank you.
Joaquin, you have to unmute.
Okay, I think we'll go on to the next presentation from Gabriel Di Bella and Rafael Romeu.
And if I may interject 1 second, this presentation and the one that follows will not be recorded. And so if you are interested in these materials, please feel free to contact the authors later.
I believe there is another paper by Rafael Romeu and Nemanja Jovanovic.
And Gabriel.
And Gabriel also. Yeah.
And this paper will also not be recorded.
I say we still have some time to answer questions, if there are questions from the audience or other participants. So I first ask, do any of the participants have questions on the other papers that were presented? Can you hear me?
Yes.
Can you hear me? Participants.
So I think you got questions in the Q&A, Joaquin.
Yeah, Jorge Dominguez has a question in the Q&A.
Yes. Where is that question? Where do I find Jorge?
Shall I read it? Shall I read it?
Yeah, can you read it for me? Yes. Please.
Yes. Currency stabilization occurs during July when the protests take place. Did the protests have no impact on the exchange rate? Alternatively, was there an impact, but the central bank intervened to stabilize the ER? Did you get that?
Yes, I assume that's about the data. So all I saw in the data June 11th was really where you see the volumes. Let me see if I can maximize this page display screen mode. So to Jorge's question, so we see
Any other questions from participants?
This is Gary. If I can anybody hear me?
Yes.
Yes, okay. It's coming on my speaker very distorted. I'm continue to be confused. I continue to be confused as to whether or not somebody in a private sector can buy foreign exchange and then use it to import. It seems to me that they've essentially blocked all ways of allowing the private sector to finance their imports. Yes, no, maybe?
Gary, direct your question at someone. So like Luis,
Oh.
answer.
Well, I'll direct it to you. I'll direct it to you.
No, I don't think so. I think you have to, I mean, how would you get access to the ports? So I don't know. It would have to be smuggled in, but then the airport's pretty tightly controlled too.
Well, I mean, the government has said you can import via a intermediary. And they've actually publicized a couple cases where that happened. But if you can't get foreign exchange, or you can't use foreign exchange, what do you do?
Gary, if I may make a comment about this, the government just recently dropped the tariff on baggage carried by travelers. A lot of that is essentially small-scale imports that are brought in by cuentapropistas and other merchants. So there is a small market whereby imports do come, and people travel to Panama. Panama used to be one of the main markets, and then buy things in the duty-free zone and bring it to Cuba. So there is that, number one. Number two, there is, of course, a dollar market in Cuba for all kinds of goods, especially high-priced goods that trade in dollars, even today. So that we really have three currencies. We have the CUP now, we have the MLC, which is a very funny thing because supply is constrained in the stores. So it really is a pretty bad deal. And also, as Gabriel mentioned, there is a huge a huge markup at these stores. For TVs, it's around 100%, but for other things, it's much higher than that. So we have that, but we have the dollar market for apartments and cars and so forth. They trade in dollars in Cuba. So that's the third currency. And so we have a triple currency system still, not a dual currency. Before we had the CUP, I mean the CUC also. So we had CUCs and dollars. Now we have the equivalent, but it's a triple currency system. But I think the paper on the exchange rate was excellent, and I had a lot of questions about it. One is whether there's a big spread, a big dispersion of rates. And I wonder if you are using all bits or all offers for quotes, because what I find is that the bid offer spread in this market is as you may expect, it's very wide, because it's a you know, sort of quasi, it's a gray market, maybe a black market, and then you have essentially illiquidity problems. So that's one element. The other interesting thing is that your numbers show that the arbitrage between the dollar and the euro seem to be working, because I think I quoted from one of your numbers that the implicit euro rate was like 121 or 122, and the market is 118. So that's pretty good, because what I was saying before is there was a huge arbitrage opportunity. At some point, the euro was trading at 140, some crazy per dollar, way over the international market. So that's another question.
Yeah, I mean, this is very sort of early days with these data, so I don't know, but I haven't seen anything too unreasonable in terms of like arbitrage. And, you know, one of the things that we saw was the volume immediately moved to euro when they do this announcement, and you see dollars flood and then sort of die down once you can't use them anymore. And so the whole thing makes sense. It looks like it's a good reading of what's happening inside in terms of liquidity conditions.
Oh yeah, no, it's excellent. Now, which, if you can reveal them, I've looked trying at Facebook and some of the social media, and I get only a few quotes. So can you tell us a little bit more about which social media were you looking at?
All the same ones you are. We just, you know, we have the power of computers. So
But yeah, but when I query, if I ask him, can I wait? Give me a dollar bits, and I didn't get any. So maybe I'm not doing this right. I put can I wait dollar bits, and
yeah, I mean, you know, it's a lot of work. You'd be there all day. You go one by one.
No, it's actually it's an amazing paper, and you know, it's a very good idea. And so the same for the model. I think the model is very interesting, and I look forward to seeing it.
Larry, do you want to make sure there's no other questions in the chat? I think there were a couple more.
Let me look.
Larry, you see any other questions?
Yeah, there's a question, Rene Costales. One of the criticisms of dual or triple currency exchange systems is that they increase opportunities for speculation. Can you measure the recent decrease in speculation, if any?
Is that for me?
It doesn't say anyone who's interested can
That's
take it.
Gabriel.
Oh, that's for you, huh?
I mean, all we can measure, Rene, is the, you know, is that we don't really have any. So speculation would mean people buy, presumably to hold and sell later, or in exchange. I think we see. I think we don't see speculation. If you had, I don't see in the data. I'm not going to show it again because Larry has to stop the recording and the whole thing is a pain. But you don't see, you see a steady increase in the parallel rate. Then there's a policy measure, and then it comes down. Speculation to me would have been the increase, and then suddenly there, you know, there's like something in supply that shows that people knew it ahead of time, and then it would happen afterwards. I don't think we have enough data for that, or not sophisticated. You know, these are cash markets. Like somebody shows up and buys, great. They don't, too bad. So we don't have like position, you know, data on their positions, or even the brokers. Did they clear out their inventories before, things like that.
Okay. And there's no external speculation in terms of the way in which, for example, Cuba's debt and debt repayment is renegotiated. I know there's not much currency exchanges, but we're looking at internal speculation, but is there external speculation as well?
Well, we've looked before. There is, I think that there's a clear there's a clear market for that. I don't know how liquid this instrument is. There's an investment fund based out of Miami, the Hertzfeld Cuba fund, and I always look at them, but it's not very informative. If this thing were, you see it move when like Fidel dies and stuff, but I don't know how liquid or how in tune it is with the market.
Okay. Renee also asks, who benefits from this differential treatment of dollars and euros?
I think the government of Cuba benefits because it forced people to get their dollars out from under their mattresses and enter convertibility. And indeed, if they are facing higher costs to dollars because of the financial restrictions, whatever, you know, I don't know that that's true, but let's assume it is, then they also benefit by having lower transaction costs. But I think in the short term, it benefited them by forcing people to produce dollars in the cash parallel market and slow it down and give them time to do countermeasures, maybe increase supply or whatever.
And I've got a question from Jose Gabilondo. I'm trying to understand the assertion that the basic dual currency, dual rate system continues in operation as it was before January 2021. Hasn't the Tarea simplified the system by eliminating the government's internal arbitrage through different intragovernmental exchange rates? Isn't that material? Before that Tarea, COOP, COOC, and Forex were used. Now, isn't it only COOP and Forex, including the MLC? And that's again directed to any of the panelists.
Anyone who answer?
Joaquin, just ask Luis or Gabriel to answer. Luis, answer.
Yeah.
No, I think the basic conclusion that Gabriel mentioned, that
Luis, unmute.
no,
Luis. Unmute, Luis.
yeah, I am.
Okay, there you are.
No, I think the basic conclusion that the unification has not changed much the workings of the economy is correct. That there are some changes in the mechanics, but basically the conditions were not there for it to make use of the huge. There's been a huge change in the real exchange rate in Cuba. There's no question about that, because non-tradable prices are really, you can see it even before that they were going up immediately before, and now they really went up quite a bit because of the devaluation. So that fundamentally there's been a change in relative prices. That's huge, but the conditions were not there to make good use of it. And that's the big problem. In other words, you know, as I think Omar Berleni mentioned this morning, the supply conditions were not there. The elasticity of supply in Cuba of exports has always been very low, and that has not changed one bit. And the same for production constraints. So that yes, they're incurring the cost. There's been a huge cost to it because one way or the other, inflation is going up. Although how it's going to be measured is a question. But I think the mechanics of it are secondary. In other words, in terms of not having cooks.
There's a question from Felipe Mantega. The dual exchange served as a taxing instrument where labor hired by dollar-paying corporations paid the tax equivalent found in the gap between what labor was paid by the government and what the government was paid by the dollar-paying enterprise. Any insights into this confusing tax transfer from workers to bureaucrats? And again, directed to anyone.
This didn't change I mean, this continues to be the case. I mean, this, I think it's not related to the exchange rate system.
Right, but within the question, I think is also the question if traditionally outsiders paid the Cuban state with dollars, it seems that they can continue paying with dollars and they will continue having the same sort of relationship they had before 11 June. They don't have to switch to euro. So that doesn't change from the outside. But it does appear to, and it may have no change on the inside. So part of the question I think may go to the tax, and part of it may go to the choice of the use of currency, either at the instance of the Cuban government or by its foreign partners. No change?
I don't know, maybe Rafael has something to add. My point is, if I understand well the question, I think that this is a question unrelated to the workings of the exchange rate system or the dual exchange rate system. So this can continue with the current system unchanged as to the way it worked before. And my understanding is that continues to be the case after the Reordenamiento. I mean, doctors in Venezuela continue to be paid in dollars, for instance, and doctors just receive only a fraction of what is paid by them that is defined by the state, and it has not changed after the elimination of the cook.
Any other question?
If I may, I have a question.
Yeah.
My question is this: given both the similarities and differences of the quote unquote new system, which can be old wine in a new bottle, how stable is this? I get the sense from the presentations in this panel that the half-life of this new system is probably not going to be very long. Is that your sense, or is there a sense that this new system, modified, of course, periodically to suit the ministries, is this new system going to stick around for a while?
I can try to say something. It's very difficult to do speculation on this, of course, because it depends on many different factors. But the system can go for decades like this. I mean, there is really nothing that intrinsic to the system that can break it, provided that there are enough dollars to buy enough goods that basically are enough to make the binding constraint right now a little bit less binding. Is completely similar to the way it worked before. So the system in itself can continue working. It's going to be inconvertible, of course. There's not going to be inconvertibility. It's not going to be what was imagined, basically that people can trade freely at the exchange rate, like plain vanilla exchange rate to fixed exchange rate system, but the system as it's working de facto right now can continue. There is nothing intrinsic to the way it works that is going to make it by itself basically disappear.
Anything else?
Well, I think there are a lot of things we could say. Whether they're wise or not, I'm not sure, but I think that the constraints are such that policy changes are going to be needed because essentially the external constraint is binding and it's not being solved. The reaction of the policymakers has been to tighten up things. You know, for instance, the whole mechanism for capturing dollars through the MLC system essentially doesn't work because it discourages transfers, it discourages remittances and money flows and makes the situation worse. And the answer is that there must be some liberalization. But you know, the instincts are always to have more controls rather than doing liberalization and allowing markets to work. And I think they're going to have to face this. And I don't think that policymakers are have gone over their fear of reform in Cuba.
Roger Betancourt noted before the government could use kook to some segments at 1-to-1 to the dollar, now they can't.
Yeah, I mean, if I can just briefly say that, sure. I mean, the government, state enterprises were importing at 1-to-1, and now they are supposedly going to 1-to-24. And but we've seen the prices of state goods have been controlled. Therefore, and they're trying to cut subsidies, but essentially subsidies have been maintained, and for some goods have had to be increased because the initial tariff increases and price increases have been adjusted down. So the answer is that this is feeding into the fiscal deficit. Some estimates have it as high as 30% of GDP. So essentially, yes, I mean, the subsidy structure, they tried to deal with this by having initial huge tariff adjustments and price adjustments in some things, particularly utilities. But they've had to go back, and the consequences, of course, you know, the subsidies are, the amount of subsidies is increasing in the economy. The subsidized flows have increased, and it creates a quite complex stabilization problem.
This is Gary. I would argue, I think, that what makes the system unstable is that they really have no way yet of allowing the private sector to increase production and begin to meet the country's needs. They're talking about, of course, putting more people in the private sector, opening up more opportunities for the private sector. But again, as far as I can see, you know, to the extent that the private sector needs to import either intermediate goods or production goods, capital goods or whatever, there's no way to do it. So they're not going to be able to increase production. Maybe in in agriculture, but even there, you know, there's a shortage of foreign exchange for fertilizer and so on. Anybody can comment and nobody can
If I may
comment.
say something there, the last system lasted for what, 30 years, almost 20, 25. And it went through, of course, a few crises, but it resisted. It resisted because every time that the fixed peg basically was not enough to actually, or was not the right exchange rate to actually absorb all the coup overhang or the cook overhang. Basically, the black market was the market that basically complemented the other two. Now, what happened in 2020, and I'm talking about strictly economics here, I don't want to bring social issues or new generations, just strictly economics. If one looks at external inflows into Cuba, one sees that basically are tourism, Venezuela mainly, and some others. I mean, occasionally some trade debts with some countries. What happened in 2020 was the perfect storms. Prices of oil went to the floor, creating extremely strong external constraint, both for Cuba and Venezuela, clearly, and tourism flows completely stopped. So oil prices are back. And tourism is rebounded slowly, but it's rebounding. So it is not that we are seeing black market premia of 400% or 500%. We are seeing black market premia of what, 250%. So if there is some recovery on the back of oil prices in Venezuela, and so some further moderate Venezuela flows, and if tourism recovers again moderately to 70–80% pre-COVID, I don't see why not we can go again to exchange rates that are going to be pretty close to 24 again. The issue, of course, is that the story is not a good story because, again, economy continues to work with all the constraints that it has worked for the last 25 years. The system is going to continue to be inconvertible most of the times, maybe sometimes with bouts of convertibility if oil prices go higher or there is a good tourism season. But the truth is that if one wants to make a prediction, it's always very difficult, but I always want to make a prediction of how, if whether this can survive or not, the system can survive or not. I mean, basically what I would answer is look at the previous, look 24, I mean, it lasted 25 years. And the only reason why it did not continue is because the printing press to print cooks was the same printing press to print coups. I mean, they cannot print dollars. So in that sense, this system is tighter to basically vacuum all the effects in the island than the previous one.
Gonzalo Cordova asked a question. Please comment on restrictions on the internet on its effects on black market transactions.
So in our data, what we saw, so you would presumably would see these in July. After July 11th, it would be very confusing because my big data event is June 11th and the protests are July 11th. It's a coincidence. I had no idea why. Maybe it, like I said, maybe it's a 30-day incubation period before people get really angry. But we see, limited evidence. If the internet were not working, we could not get readings. And we do see a decline in July in readings in aggregate, but it's about 15% relative to June. Unfortunately, we stopped taking readings for this conference on August, whatever last Saturday was, that Sunday. So I only have 1 week of August, but August looks on track to go back to June numbers. So there probably was some slowdown in internet access intermittently, but not anything that would, you're talking about, instead of getting, 8,500 observations in a month, and that's huge. So daily observations for given the internet restrictions in Cuba that you're pointing to, the regular ones, not the extraordinary ones, because of just the regular cost of the internet, the inability to get internet, nobody getting internet, we could get between 30 and 200 observations reliable that we believe we can use a day. 200 is like the June rate. 30 is the March rate when the market is calm and flat and nothing is happening. So we think in July, they were probably at a level of like 150 instead of 200, where you should have been at 200. But then again, maybe people were tapering down their use of the market after they had dumped all their dollars. It's all very speculative, admittedly.
A question from Roger, just to refine the question that we asked earlier. They asked earlier on the COOC. The question here relates to the ability to issue convertible currency to some segments at 1-to-1 to the dollar, which they now can't. But is this a case where the resulting subsidies will just go to different people, but that the overall effect remains, the overall structure remains similar?
Yeah, I think that's correct. I mean, the standard prices were using largely 1-to-1, although there were some reportedly that we were using 10-to-1 before the devaluation. And now the subsidies are directly used for things like foodstuffs. There's a huge subsidy mechanism for food products that they by the way, they just now increased the wholesale price that is accrued to farmers that supply the Acopio system, the wholesale price system, whereby the retail price has been fixed. So that, yeah, the structure of subsidies has changed quite a bit. But the fact is that the total amount of subsidy in nominal terms has increased quite a bit. And it's accelerating from the plan. I think the original plan was to have a deficit of 18% of GDP, a consolidated fiscal deficit of 18%. And it's now been essentially blown out because of largely subsidies. I mean, there is an element. The other element is this MLC system is very interesting because essentially it really is a tax that is being operated through the dollar stores, the MLC stores, and the markups are huge. So there is a dollar tax, but I think it's a perverted tax in the sense that it's discouraging the use of these stores because in Cuba, people know that the price, I looked yesterday, a couple of days ago, at the price of the TV at the dollar store in Cuba and the price at Walmart. Well, the price was essentially like 80% higher at the dollar store as in Walmart. And I looked up, the Walmart operating margin is something like 26%. So you add up this 28% to that 84, and then you get a huge implicit tax in these dollar stores. But people who are operating in this MLC, both people who send money through remittances, and by the way, this is the single most important flow of dollars into Cuba now, because one way or the other, remittances flow, and receipts from medical services way down, tourism is way down. So the major source of foreign exchange in Cuba comes through transfers, through remittances. And then the main mechanism is a tax mechanism which uses these stores. And the implicit tax is very high. So the answer is, what about lowering this tax?
There, if I may, Luis, and I combine this observation with one that Gary asked earlier about imports. The issue is that it's not a tax. It's really, I mean, believe it or not, there are two markets in Cuba that actually are price clearing markets. The black exchange rate and the tiendas of moneda de libre convertibilidad. The reason why appears that there is this very high tax, as you mentioned, it's really what's going on is, as you mentioned also, the main source of foreign exchange for the island right now are remittances, but imports are basically decided by those remittances, right? Plus whatever is the foreign exchange that comes to the government in the form of the Venezuela-related flows and others. The problem is that the government needs to, with that money plus remittances, need to pay a few things. Intermediate goods to produce electricity, intermediate goods to produce whatever is produced in the island, plus whatever is needed for the functioning of the state, plus what is sold in the tiendas of libre, the moneda de libre convertibilidad. So you have the same pool to buy three types of goods. I'm simplifying. But remittances in its totality are going to the tiendas of libre convertibilidad. So basically you have a pool of dollars at this point going to these tiendas that is much higher than what the government can afford to put in these tiendas. And the result is this seeming tax that you mentioned. If the government would sell goods at a markup like the one that you mentioned from Walmart, there would be the same type of lines that you see at the libreta, you would see that you are seeing already at the tienda. And it would be much more quote unquote scarcity because there would be too many dollars. Because again, the problem is not the fact that remittances have decreased. The remittances actually are increasing. The problem is that what the government uses to buy the goods that go into the tiendas is not what receiving remittances. Part of that goes to other type of imports. And this is what we're seeing. If at some point there is a normalization of the income in dollars of the state, then the prices are going to decrease and this tax is going to decrease. So, and this is what's going on right now.
Well, yeah, I mean, but you remember, I'm not talking about the Walmart margin. I'm talking about 80% plus the margin, the normal margin, so that the actual margin goes up to well over 100%. So essentially, people who send money and buy it realize that they're getting for the remittances, are getting a fraction of the dollar value, and these stores are in dollars, so there's no exchange rate problem, and we're talking about dollars. So essentially, it's a tax, and
no, it's not a tax. Again, this is a market clearing tax. Imagine this. The problem is that there are only a few goods. There is nothing related to the exchange rate. There are only so many goods for an enormous amount of dollars that come in the form of remittances. And the way these tiendas are being managed is that the price in dollars increases in order to siphon as much as possible those dollars. So this is what's happening. It's not a tax. It's just a market clearing in order for basically absorb as many dollars as possible in the form of remittances.
well, that's an interesting way of looking at it.
Well, if there are no more questions, the our time, I think, is coming to a close, and I was going to invite Joaquín to bring us to closure.
Okay. I want to thank the participants for their presentations and the listeners for having heard us. And we will have another session today at 7:30 for questions and answers. Thank you.
Thank you.
Thank you.